All right, hello, and welcome to a video about the federal budget for 2021-2022. It got announced 2 nights ago. I bet you're excited about it. You're going to need to know it all for Unit 4. Economics is going to be incredibly important to Unit 4, Area Study 1. So I've tried to break down some of the key points about it in just really short form about what's new or being extended in this year's federal budget that will help you later in the year and in your end of year exam. If you want to check out anything else to do with the budget that's going to be relevant, there's a lot of really good stuff in the budget year from last year. A lot of the policies from last year's budget are honestly probably a bit easier to use as examples, and it's still relevant being within the last 2 years. So I'd highly recommend checking out that, where we talk about job seeker, job keeper, job trainer, job maker, all the job policies, as they are really easy to use as AD and AS policies. But for now, let's get into a little bit of a summary of the 2021-2022 federal budget. So first and foremost, one really important thing is that this budget is a forecasted budget. So there's a forecasted budget of a $106 billion deficit. That part's pretty important because that's what the government thinks they're going to spend. Obviously, we are living in quite a volatile time where things can change very quickly. We have different variants of coronavirus coming out. Somewhat regularly, it's mutating, transforming. Vaccinations are coming out. The next 12 months could easily go in totally different directions depending on what ends up happening. But we are predicted to be in a $106 billion deficit. That forecast is important. It's forecasted or estimated. The final budget, we won't know until next year once that money has been spent and received. The biggest spend has been $17.7 billion on improving aged care. That's obviously going to do a lot in those areas. You could look at that in a bit more detail, but it's going to create jobs and many different things in the area to make it safer and more efficient. But that's been the biggest area, obviously stemming from last year, where there were a lot of issues in aged care not being managed very well, which led to a lot of COVID-related issues. And also it was announced that we're expected to be in a deficit, meaning the government's spending more or outlaying more than they're receiving for at least another decade. So there's going to be another decade of deficits. If you're a little bit pessimistic, like I can be at times, the government often likes to promise how long we're going to be in deficits and when we're going to return to surplus. We've been aiming to return to surplus for 2 decades now, and it has not happened. So it's tough to know for sure if it would. Like if you look in the budget, there are a lot of forecasts of what's going to happen, and for the foreseeable time, they've always predicted within 4 years wage growth is going to get to 2.5%, and it has not happened. So the government can be a little bit cheeky in the numbers that they include. But let's look at a couple of specific policies in the budget and talk about the impacts they may have. First up is the tax offset for low and middle income earners. So what this is an extension of a policy that was in place in the last 2 years, and they've extended it further. And there's a few interesting things about this I'll bring up later on, but the relevance for it now is that it's up to a $1,080 tax offset for low and middle income earners. That $1,080 specifically ends up being for middle income earners. Low income earners usually get about $255 for a certain amount and an extra amount of cents per dollar they earn to work out how much of an offset they'll get. The whole purpose of this is that they're aiming to increase the disposable income of households when they do their tax return. So when you do tax return, you'll get that $1,080 extra back, which will hopefully then increase consumption spending, which will then increase aggregate demand. If we then increase aggregate demand, that can then lead on to increased economic growth as businesses are happier to produce, which will hopefully lead to decreased unemployment as more production is required, more labor resources are required, and therefore hopefully get us towards achieving some of these goals, which we have been very far away from over the last 12 to 24 months. This could also help stimulate the inflation rate from our current around 0.9% up towards what we would prefer it to be. So one thing about this tax offset, which is kind of interesting, is that it's been referred to by some economists, which I enjoy, as I'm going to draw because drawing makes it more fun to refer to. So if we do this through the middle. Oh no, what's happened there? We do this through the middle. And then we do some of this around here. So it's been referred to as a Lamington tax, and this is a very, very crude Lamington. And what essentially that means is that the best bit of the Lamington is the jam in the middle. And that's where we are right now. Beforehand, we were paying a lot more tax. Afterwards, we're going to be paying a lot more tax. After this offset goes away, we're going to be paying significantly more tax, and we're going to be worse off because of it. So in the short term, we are going to be benefited with increased aggregate demand, but in the near future, when it goes away, potentially next year, we are going to be paying a lot higher of a tax. We're going to have a higher tax burden overall. We have childcare subsidies. Around $566 million per year will be put towards childcare subsidies for families from July 2022 to aim to get more parents back into the workforce, which will hopefully make Australia more productive. That whole aim is to then increase our aggregate supply, because if more people are heading back into the workforce, we're going to be more productive and more able to produce. That should increase our productive capacity, which is ideal. So that ends up being a aggregate supply side policy, so productive capacity, as it's trying to increase the amount we can produce overall. So a significant amount childcare subsidies to try and make childcare cheaper. Childcare is very expensive in Australia. There are some arguments about the effectiveness of how this policy is being put out, but that's the aim of it, is that if we make childcare cheaper for households, they'll be more likely to put the children into childcare, return to the workforce, and then we can have a higher productive capacity and more production overall. We also have an extension to the instant asset write-off scheme. This policy has been around for a long time, but last year during the pandemic was increased up to $150,000 of writing off of assets for businesses. The whole idea of this is that, and this is an aggregate supply side policy as well, which I'll throw up here. It's an AS policy. The whole purpose of this is it's to incentivize businesses to then basically buy new assets at the start of the financial year or throughout the financial year, knowing that they're able to claim the value of that asset on tax. And so that incentivizes businesses to buy new technology, new machinery that they might not previously purchase, knowing that they can get up to $150,000 worth of the value back when they do their tax later in the year. This means that businesses will then obviously buy a lot more things and hopefully make us more productive, increase our productive capacity or efficiency, and therefore increase our aggregate supply, which is what the overall aim is. I always use the example of this of when it used to be a significantly lower number than $150,000, but I used to always use the example that you'd often see at the start of a new financial year, a lot of gyms would just buy new equipment, and they were doing that because they knew they'd be able to claim the amount of its value back. And they do it at the start of the financial year because they knew new equipment can bring in clients and therefore help with their business, but also knowing that in the long run, it's not actually going to cost them anything or much at all. Then lastly, what I've included just for my own interest is that there is a $9 billion in there, which is to be decided, which is interesting. There's a bit of a prediction there that means they're going to call an election this year, and that $9 billion will go towards election promises that hopefully will allow fearless leader Scott Morrison to remain in power. But they're not saying what that's going to be for yet, but that's a fairly significant amount of money, not to mention what is there for yet. So it's a very strange thing that they're not telling us where $9 billion of a $106 billion deficit is going. That's almost 10%. That's kind of a strange thing to omit, but obviously it could be important once we find out. So that's essentially it for this budget. This budget was fairly uninteresting in terms of how we can apply it to VCE economics. There is a lot more to it, but I want to bring in some of the simpler stuff that you can apply directly to not overcomplicate things. As I said previously, last year's budget actually had a lot more policies that are easy to adapt and use in your VCE economics exam style questions. So I'd highly recommend checking that out and looking at some of those. So some of this end of stuff. As always, if you need anything economics related, feel free to see my website, www.therunningeconomy.com. If you have any questions at all, feel free to email me on that email, sean@therunningeconomy.com, or comment below. Also on the website, there is a link to a Discord where there's a bunch of VCE economics students who help each other out and are incredibly intelligent and helpful towards each other. And I highly recommend using their brains to help you do as good as you can in VCE economics. Other than that, I hope this was useful to you. Hope you have a wonderful day, and I will see you next time. Bye.